To use a stop loss or not to use a stop loss? That is the question. Really, this is an important question, and it comes on every trader's, investor's mind, because psychologically you want to protect your money that you are trading, investing with, which is totally understandable. The problem is most traders or investors go about stop loss the wrong way, because usually they tie it to their psychological level or to their account level. But of course, the market doesn't give a about your stop loss level. On top of that, the stop loss doesn't work on every single strategy. Now, if you are one of my students in Algo Trading Masterclass, then you know I don't like stop losses, and usually I tend to put a stop loss as a catastrophic level because I want to give my trades the opportunity, the leeway to move up and down until it hit the target or the indicator that make the trade exit. But of course, some of you will come out and say, but wait a minute, what if your stop loss is too far, then you're gonna wipe your account. That is true if you're trading a single strategy. But of course, I never advocate to trade a single strategy. If you don't have enough money to trade more than one strategy, then you should not trade. Trading a portfolio is extremely important on many levels. When you trade a portfolio, you have the benefits of spreading the losses over many strategies. Say you have, let's say, 10 strategies trading in a portfolio. Let's say you have 100,000 capital. If you are trading one strategy and that strategy on average loses 1%, so your average loss is $1,000. Let's say you don't have a stop loss, you tested your strategy, on average it loses 1%, so that's $1,000. Now let's assume that a shock hit the market. So this 1% now becomes 10%. That means your portfolio just lost $10,000. Now take this example. Instead of trading a single strategy, let's say you are trading 10 strategies, and now you've divided your capital over those 10 strategies. So now the same strategy have a capitalization of $10,000. So a 1% average loss is actually $100 on the whole portfolio. When this shock happens in the market, this 0.1% will become 10 times as big, which means it will become 1% on the whole portfolio, $1,000. So that will bring us back here. That means when I trade a portfolio, a shock in the market on one of my strategies will make it just like the normal stop loss on a single strategy. Now, might be a little bit difficult to consume, but this is the gist of it. Basically, trading a portfolio actually already take a lot of your risk out of trading your capital. But of course, you cannot just stop at that. Remember, I told you need catastrophic stop loss, which is, even 10%. What if 50% happens? You still need to protect your capital. But the stop loss definitely shouldn't be that I cannot lose more than $200. And let me prove that with testing. Okay, so here we have a trading strategy. This is the ES.D, the S&P 500. The strategy here is the RSI2. Below 25, we buy. Above 75, we exit. And we have a filter, which is the 200-day moving average. This strategy on the S&P 500 made $97,000, and this is the curve. It's a beautiful strategy, and this is the drawdown, about $20,000, which equates to about 11% here. This strategy has no stop loss, and if I show you the trade analysis, you can see that on average the winning bars are 5, so the average is about 6.1 bars. Now let me introduce a stop loss. So here I will optimize for stop loss between 0 and 24,000 in 1,000 interval. So we get 25 variations, and this is from 0 to 24. Remember, originally 0, we have $97,000 profit, 22,400 drawdown, and you can see the catastrophic stop loss is somewhere around here. That's $21,000, because that means this stop loss didn't hit. $20,000 did hit once. I checked the trades and it did hit one time. So of course, even if you don't have a stop loss, let's say you have a catastrophic stop loss of 21, remember you need to have the capital to handle this $20,000 stop loss. But let's look at the performance. A $1,000 stop loss reduce our profits to 32,000 and actually increase our drawdown. 2,000, same thing. Increase the drawdown, lower the profitability. Same thing on 3,000. Only at $4,000, then we reduce the drawdown, but we reduce the profitability. In fact, there is no way to increase the profitability of a mean reversion system with a stop loss. And this is an important concept to grasp. Stop loss is not there to enhance profitability. In fact, most of the time, 95% of the time, a stop loss will hurt your performance, or it will increase your drawdown, or it will actually make your risk-adjusted return worse. Sometimes it does help where it enhances your risk-adjusted return. Risk-adjusted return meaning you make less money, but on lower drawdown. So overall, you make better return to drawdown ratio. But testing is the only way to do it. You cannot just go, I want $200. Because with this, in this case, let's say you cannot handle more than $2,000, where it doesn't matter because the market doesn't care about your $2,000. And in fact, you will hurt your drawdown and your net profit. So this is now the same strategy, and I just plotted the 20-day ATR. This is the average true range over 20 days. The one in cyan, this is the same thing, same ATR, but now you can see it's different number because this is now in dollars. So this is now the average true range in dollars for the S&P 500. And you can see why the lower number for dollars hurt your strategy. Because, for example, for 2022 on average, we are hovering around $4,000. That means every day the probability is extremely high. The day will go up and down with $4,000. So if you bought yesterday, it's very likely that today you will face a $4,000 stop. So anything below $4,000, most likely you will hit it. And anything above $4,000, most likely you will not hit. So if your account can only withstand, or let's say your psychology can only withstand $200 loss, then you need to look for an instrument or a time frame where the average true range is below $200. So it's less likely that you will hit this stop loss. And we can see here, this is the stop loss value. $4,000 looks the sweet spot. So yes, we don't make more money, but it's lower drawdown. So that's about 10% lower drawdown. And let's say about 20% lower profitability. Now this is the ATR multiplier. So we will start from 0 to 4, step 0.2. So here is our original strategy. And now this is the ATR, and we can see with the ATR, because it is adaptable. Look at this. Now we can actually make more money with lower drawdown. So from 2.8 ATR all the way to 3.8 ATR, we make more money, and sometimes with lower drawdown. And the reason is because this ATR is very far. Plus 3 ATR, it's highly unlikely that you will hit this ATR. The reason it makes more money while with the fixed dollar we didn't make more money, it's because this is adaptable. So when the volatility shrinks, this will shrink. When volatility expands, this will expand. But remember, even then, because this is rarely hitting the stop loss, you can see that the performance enhancement is not significant. But as a catastrophic stop loss, this is a perfect place to do my stop loss. This is now a trend following on the same symbol. We are buying the 40-day close high, and we are selling the 20 days close low. The winning trades have 11.7 bars and losing trades have 4. On average, we are again same amount of days in a trade, just like the mean reversion strategy. Now let's see the effect on this strategy using a stop loss. So we'll start with the stop loss as a dollar figure. Again, same thing, 25 combinations. You can see that the catastrophic stop loss could be $8,000, and then we achieve the same amount. So So this is 92.23. So at $8,000, I could have the same thing. While with mean reversion, it was $21,000. So you can see that the strategy style does affect where you place your stop loss, even the catastrophic stop loss. Of course, you can see that we don't enhance the strategy with any number when it's in fixed dollars. So now we will put the ATR multiplier again from 0 to 4. This is the average true range for 20 days. So this is our original strategy. So this would be a better risk-adjusted return because this is around 16% less drawdown, and this is about 11% lower profit. So we get better return to drawdown ratio. And this is around 0.6 ATR. Remember, for the mean reversion, we were looking at around 3 times ATR. Now, if we go to 3 times ATR, we achieve the same results. So this is a little bit lower and same drawdown. So 2.8 around the same thing, 3.2 around the same thing. So around 3 ATR works well as a catastrophic stop loss for mean reversion and for trend following. None of them, either an ATR or as a fixed dollar, enhances our system. And of course, the closer you are, then the worse your system is going to be. So now looking at 3 ATR, for example, today is around $4,000. That's $12,000 stop loss. Of course, you need a big account to handle that kind of stop loss. So or if your account is small and you cannot, then you don't even have to look at other instruments, but you can target this instrument when it has a lower ATR value. So for example, for the ES, there is the micro ES, which is 1/5 of the original ES. So a $5,000 stop here will be $1,000 in the micro ES. But also there is another way. So here I drew this level. This is $2,000. And you can see, so most of 2022, we are above $2,000. But that doesn't mean it's happening all the time. Look at this. A lot of times you are below $2,000 ATR. So that means you can trade this instrument with a $2,000 stop loss when your ATR is below that. And we can go back. You can see there are many times. Look at this. All of 2017. So 2 years in 2017, 2016, we are below $2,000 in terms of ATR. So that's another way to trade this instrument when you have a small account. You can trade with a stop loss of $500 even, but you need to wait for the right time of volatility to trade that instrument. Or of course, you can go down to the micro ES. So the takeaway, the overarching theme is that stop loss usually hurt your trading performance. Doesn't matter how you cut it, it will usually hurt your performance. And it affects different style of strategies in different ways. So you cannot just slap $1,000 stop loss on every style of strategy. And also, it's not the same for every instrument. To place a stop loss, you need to give it more than 1 ATR, more than the average movement of that symbol over a 20-day period. To learn more, make sure to watch these videos, and I will see you there.